this as dark clouds are forming around credit and commercial real estate. Joining me now is ERShares CEO Joel Shulman. Joel, thanks very much for being here. Are you seeing the same kind of reaction in terms of money moves and inflows?
Well, yes, it's interesting. We saw some money going to international markets when we saw the dollar coming down. We're seeing it come back into the U.S. markets. And I agree with the comment that was just made that the market's a little confused here in terms of what's going on. The Fed's being very clear they're going to raise rates and continue to raise them until they've got inflation under control. And they've got a tough job ahead. I mean, this idea of no landing, a lot of people are talking about no landing. I think that's gone. I think we're moving more towards a soft landing. But what's interesting is we've seen almost a textbook vertical shift up in the yield curve. It's gone up about 20, 25 basis points through the month of February. And we saw actually 5-year rates, driving quite a bit up 70 bips, but 70 basis points. But the yield curve shifted up. It's still inverted. It shifted up 25 basis points. As an academic, it looks like a textbook. I'm also a fund manager, but it looks like a textbook academic shift up by about 20, 25 bips.
Yeah,
which means we're looking, the market's, the market's pricing in one more rate hike. Go ahead.
One more rate hike, how big? 25?
No. I mean, one more on top of what they were expecting. I think they're expecting 2 more rate hikes. I think now they're thinking 3. So an additional rate hike. So 3 more in total, I think. But originally, I think they were thinking 2 more.
Joel, at the same time, we're seeing the macro story get weaker. PIMCO has defaulted on a $1.7 billion office property. This is one reason that has sparked lots of research on Wall Street this morning. Piper Sandler writes, dark clouds forming over credit. The Brookfield and PIMCO commercial real estate defaults highlight the impending negative credit cycle. Less visibly, consumer delinquency rates are rising, even with record low unemployment. It's very unusual as the banks tighten up. And you always have banks tightening up their lending right before a recession. Do you expect a recession this year?
I think we're going to have a soft, I think it's going to be a sluggish economy. I'm not using the term recession because I think it's going to be one with very low unemployment, but we're going to see a sluggish economy. But we've got to also remember, there are a number of companies like Nvdia and Salesforce and Okta and even this morning VMware. There are a number of companies, primarily entrepreneurial driven, that are really doing fantastic in this market. So from an investor standpoint, it's really a stock picker's market. In fact, those companies helped us be the #1 fund in the last 3 months. So we've been picking these entrepreneurial companies where they know how to navigate these troubled waters, and they're cutting costs and doing what they have to do.
John Lonsky, jump in here. I wonder what your thoughts are on this $1.7 billion default.
Well, that is a sign of things to come. Unfortunately, we have a very low occupancy rate for offices, and I would imagine you're going to see more defaults tied to commercial real estate that has exposure to office space. I'll add that I know of a very large shopping mall in this area that is on the brink of going into default. I think you're going to find that there are going to be problems on the real estate front. That's going to be felt throughout the economy. I might add, thus far, Twitter has gotten away with firing 73% of their workforce. And I can't help but think that other companies are asking themselves, maybe there's a lot of fat to be cut out there, and we're going to see a drastic deterioration of the labor market, not right away, but perhaps later this year. I wouldn't be surprised if this recession doesn't start until late 2023 and then carries over into that 2024 election year.
Yeah, well, that is something to watch. Joel, are there areas that you find investors want to hide when worried about commercial real estate vulnerability?
Well, your guess, your guest makes a good point. I mean, with real estate, I mean, we've not yet seen it hit the CPI, and this is one of the things that's very annoying with the CPI statistic that has a 30 to 40% weight on real estate or housing. So the housing market to me, and I know he was talking about commercial real estate, but in general, We're not seeing that come down. In fact, if anything, it went up. Mortgage rates came down from 7.3% in October, and they dropped a little bit. Now they're coming back up again. So the real estate factor, is a little surprise to me, particularly when you look at the Case-Shiller index and other things, which are showing what your guest said, that that the real estate is sluggish in many areas, and we could have some defaults. But the CPI is still showing it going up. In terms of pockets and what investors like to see, I think they're looking at companies that have made good progress. There are actually a handful of companies that are expanding margins. I mentioned a few like Nvdia and Salesforce and even Okta. These are high-tech companies. They're expanding margins. They're growing revenues. And their pockets there, and they're getting their costs under control. And I think for a corporation, particularly a publicly traded corporation, getting your costs under control is order number one. Making sure you have the working capital, see through whatever trouble times you have to have. Trying to focus on your value proposition. These are all things that kind of old school things that they need to do, particularly in a tricky market like we have.
All right, Joel. Thanks very much for weighing in. Joel Shulman joining us this morning.